Hi, everyone. In this session, we are going to talk about inventory, which is the uh, second item in the balance sheet and the current assets in the balance sheet. So, what inventory is? That's the inventories as you see in the balance sheet of Apple, and this is the definition of inventory, which refers to the raw materials used in production as well as the goods produced that are available for sale. So it could be the material that the company bought from a supplier, or it could be the finished product that the company has or the company is aiming to sell. Also, there are three types of inventory: raw materials, work in progress, and finished products or finished goods. That's what we were talking about. So, and it's categorized as a current assets on the company's balance sheet. So, you could think about inventory that that's a very good thing to have and like give me more of it. And honestly, that is not always the case. For example, if you pause this video and you go watch this interview in CNBC television, especially at the after 35 seconds from the start, you are going to understand why having extra inventory could harm the business. Because at this, the interviewer here, what she said was the gross margins every day was looking for this because it has been a decline as they have to unload inventories. This is about Nike. The problem was, or the problem is, if a company has an excessive inventory, they will try to unload this excessive inventory, and when they do this, they are going to sell the products or to sell their products on a discount, and this will um, influence the margins of the company. We talked about the margins, the income statement. We talked about the net margin, operating margin, and gross margin. So when they do this, when they sell the products and a discount, this will affect these margins and will affect, of course, the profitability of the company. So that's why it is extremely important to know or to manage your inventory in a good way. So here, for example, that's also we're still in Nike from their annual report. What they are saying here, the wholesale revenues decreased 2%, primarily reflecting liquidation of excess inventory in the prior year. So that's what we're talking about because they sell at discount. And here, failure to accurately for that's one of the risks that the company should mention in their annual report. They were saying failure to accurately forecast consumer demand could lead to excess inventories, and this will lead to the sale of excess inventory at a discount at discounted prices. That's another example. That's from Apple, and this I think was at the beginning of the year. I think I took the screenshot maybe January 1st. I don't remember the date exactly, but this was coming like the stock dropped as you see here, and this is the key facts today from TradingView. They were saying Apple is running a 4-day promotion in China from January 7th to from January 4th to 7th, featuring discounts on iPhones, iPads, MacBooks, which may influence trading activity for Apple. Because when you see the company is selling in discounts, because you need to understand that this may affect the margins of the company, and at the same, so consequently this will affect the stock price somehow. So there is a ratio for you to have an idea about or how to manage the inventory, and you're not going to manage the inventory, understand this, but you as an investor to see and compare companies from the same industry and check their numbers, and if the inventory level is in a normal situation or it's coming out of it's going out of control. So there is something called inventory turnover ratio, which is a financial ratio showing how many times a company turned over turn over the inventory in a given period. And to calculate the turnover or inventory turnover ratio, it's the cost of goods sold over the average value of inventory. And you don't need to calculate it themselves. You're going to find some web tools to help you on this. But even so, it's I calculate all the ratios and everything by myself when I try to do my due diligence, and I rely on my calculations. That doesn't mean the other calculations are wrong. No, 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 no. But what I'm saying, I have my database. I got the information that I need, and I calculate every single metric by myself, which is not difficult to do so. So now let's have a look at the inventory turnover ratio of some of the companies here. So we have Walmart, Costco, Apple, Google, Nike, Columbia, Dollar General, and Dollarama. These are two dollar store businesses, sportswear or apparel manufacturer. Google, it's communication in the communication sector mainly, and Apple, mobile phone manufacturer. Costco and Walmart, we can say retailers. So the thing is, calculating the turnover ratio, it is more related to retailers, more related to manufacturers. But when you think of, for example, a company like Google, you're going to find that they turn over their inventory almost 70 times a year. Like in the period that we made the calculation, which is basically the cost of goods sold in a period of time, let's say 1 year, over the average value of inventory at the beginning of the year and at the end of the year, we take the average of the inventory. And this gives you 70 times. That means 70 times in this period, Google was able to turn over the inventory they have into products to be sold to customers, which is a little bit misleading for many reasons. The very first one is because Google, they one of the main revenue streams, it's services. Google Ads and the services that Google provides to their customers. So there is no physical product to be sold and to be an inventory and then turned over to be a product sold to customers. So you cannot here rely on saying like, Google, they are doing this 70 times a year. That's great. No, it doesn't work like this. So that's why this takes us again to the area of saying we cannot compare businesses from different industries to each other. You need to compare business in the same industry. So when I look here, Dollar General and Dollarama, Dollar General, they turn over their inventory 4.36 times a year, while Dollarama 4.2 times. Yeah, now we can talk. When you look at Walmart and Costco, I understand Costco has a little bit different, I would say, aim or vision. So it's not the exact same, and we're comparing each other. There are some differences here, but yeah, we can talk about them. When you say like when you see Apple, because Apple has some products, has physical products. I understand Google has, but Google's main revenue stream coming from the services. So here it's 30, but here it's 70, and so on and so forth. You compare Nike and Columbia, 3 and 2, 3.38 and 2.1 times. So that's the thing, like these ratios, and we're going to talk about, we already, um, or we're going to talk about other ratios. We are going to talk about fixed asset turnover. We're going to talk about basically return on assets, and many other ratios during the course. And the thing is, you cannot blindly get the number and say, "Oh, that's good or not." No, you need to understand the business, what are the revenue streams, what the business is offering, what the business is selling to its customers, so you can compare the numbers and or um, get or draw conclusions out of the numbers that you are getting. So here we have, that's a grocery store called Spirituous Farmers Market. They have an inventory turnover of 15. And again, when you compare it, you are going to look over here, for example. And they were mentioning very interesting thing in their annual report here, which is the inventory shrink. They were saying if we're unable to protect against inventory shrink, our results of operation and financial condition could be adversely affected. Because the thing is, if you, and especially in the like retailers and grocery stores and like fresh foods, if you couldn't manage your inventory in the right manner, some of inventory will go bad, will be spoiled. So you are losing money. So here they are mentioning that our business depends on our ability to effectively manage our inventory. We have historically experienced loss of inventory, also called inventory shrink, due to damage, theft, spoilage, inventory management, and other causes. So that's a very important thing to look at when you are analyzing the financial statement of the company. So, what business shrink is? It's the loss of inventory that can be attributed to factors such as employee, even shoplifting, administrative error, and so on and so.